Good afternoon. This is Ken Long at Tortoise Capital with a review of the weekend trading report for April 28th, 2018. The market is in bullish normal conditions. Just recently came out of sideways normal, so it still has some weakness in it. On an annual basis, looking at weekly RSI 14, we're in the middle of neutral with a score of 51 out of 100. Short term, using 10-day NDX, we're also in the middle of neutral with a score of 55 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is red bullish at 2.16%. The red means that this is among the worst 15% readings in the last 6 months, but it's bullish because it's slightly above that 2% threshold. So what this means is, although it's bullish barely, this is also relatively weak given the recent performance. So this is a fragile bull market that could collapse at any moment. The slope of the 50-day moving average is yellow neutral. That is weakening compared to last week. The strength of trend with the ADX 14 is 22.2. That's neutral, and so there is a balanced opportunity for moves for both bulls and bears in this weak market. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and off is 1.0. The current reading is 1.172, so we are deeply into risk on. We take that score and look at the last 5,000 trading days, find the average and standard deviation. We can compute the risk z-score, which comes in at 1.82. That means it's 1.82 standard deviations above the long-term average, meaning this has been a favorable condition for swing trading based on volatility performance. Below that, you see the 90-day moving histogram of that indicator, and you can see that we've been oscillating between -4 standard deviations to +2. This was a great swing trade opportunity. From +2 to -1.5, and then back up to +2. And so this is an area in which a sudden increase in volatility would not be surprising because we are at an extreme of relative quiet lately. And so what this means as it's rolling over is that any swing trades we have, we should be very prudent about protecting risk and preserving profits and being selective about entering new positions. We should be ready for exploiting one-day downward moves with intraday trading with the VIX or with the Russell or the financial sector. So one-day adverse moves would be a higher probability in this market condition, which could lead to a collapse into sideways markets, and we're so close to the 200-day moving average that could trigger some momentum plays. So this is a time in which we should be excellent with our short-term trading. We should be cashing them when we have them. We should minimize our overnight risk, and we should watch for the emergence of new relative strength leaders in the week ahead. In the blended monthly rebalancing, the current holdings are as shown. The next reevaluation is due soon, on or about 1 May. You can see the holdings right now, Latin America, Tech, and Japan for ETF 13 and so forth. They remain relative strength leaders as we speak, so that's been actually a good position all month. In the table below, you can see for each of the blended monthly rebalancing portfolios, the 3 leading relative strength winners in each category. Notice in ETF 32 that the blended commodities DBC and agricultural commodities DBA have moved to the top. And so this may be a time in which commodity swing trading is at a premium. You can see the sector leaders in the Dow, and among the sectors feature both energy and technology. And then in the ETF 200, you have oil and energy near the top of the list. So again, it looks like energy and commodities are on a short-term boost. So we would be ready to reinforce that with continuation patterns during the daily and short-term trading. In the ETF 13 and 32 portfolios, you see predominantly cash positions. These are broad sectors that are below their 4-month moving average, and so cash is indicated. Those that are on buy signals at price above their 4-month moving average and are a little more stable and reassuring. The only winners in the ETF 13 is the Russell 2000 in Latin America. Latin America ILF was one of the few sectors that actually had a high performance. I want you to notice also at the bottom, the ones that have been lagging over the 3 and 6 month look back are the ones that had better performances this week. So there may be some sector rotation going on, and I'm interested in real estate, which has been horrible long term, but put in a plus 2.5% gain over the last week. And so this may be a dead cat bounce, and so we would get short on weakness, or it may be the beginning of a spring for real estate, in which case there would be some owl patterns to be on the lookout for in that asset class, real estate being a little more diverse than equities. So that's on our radar screen. ETF 32 portfolio, pretty much the same thing. Notice that the commodities have moved to the top, DBC and DBA. So DBC is a blend of precious metals, base metals, energy, and something else. And DBA is agriculture. Yeah, that's the other one, agriculture. So those are moving towards the top of their cycle, and I would expect some more follow-through from them since commodities tend to swing better on longer-term basis once they turn. Utilities, the defensive sector, put in a nice move over the last week, and so that may be a flight to quality or a search for yield. If the rest of the market is poised for potential disaster, that makes sense to protect cash or risk capital in utilities. So I would not be surprised to see some more gains there. Dramatic underperformance in industrials near the bottom of that. XIJ had a bad week, so there may be some weakness in that, continued weakness in that sector. Among the Dow 30s, what has risen to the top of performance, Intel, Cisco, Nike, Boeing, and Microsoft, so there's a strong technology flavor there. Those two winners, Intel and Nike, had excellent one-week performances, so I would be looking for continued follow-through. So if the market were up and technology were better, then Intel and Nike, or Intel and Cisco and Microsoft, would be on my short list to trade as we're thinking about the logic chain. Verizon and Home Depot also had excellent one-week performances, and so they've been negative on the 3 months, so this might be the turnaround, catching in at the turn in the bottom of their channel. So I'll be trade framing those two with care, Verizon and Home Depot. 3M has just been brutalized, down 10% over the last 6 months, 20% over the last 3 months, and then down 9% in the last week and month. And so quality company on a fire sale, it's either on fire or this is a fire sale. So it's a candidate for either continued pain and a continuation on the collapsing dragon, or it may be time for a bounce off an exaggerated sell-off. So that's one that will certainly be on our short list. General Electric continued its recovery a little bit. It's been even worse longer term than 3M, but has put in a pretty good 1 month of stable performance. And so the bottom may be holding, and we'd be looking for owl patterns to come out of that kind of basing action. So we'll trade that one with an owl trade frame in mind. So next up are the sector spiders of the U.S. markets. This is about 30 some odd more finely detailed sectors than the XL series. At the top, software, healthcare, IT, energy. At the bottom of the stack, consumer staples, home builders, pharmaceuticals, and material. So I'll be looking at those extremes for additional framing, but it looks to me like energy on the long side, materials and industrials on the short side for continuations. ETF Max looks at about 500 ETFs, and this is the top 40-ish of those. And what I want you to notice are that the ones that were at the top of the list that got crushed this last month and week were the volatility. So what we saw in the risk Z was a decline in volatility, which is why those two got spanked so bad. But we're also at a turning point in volatility. And so the very size of that loss suggests the possibility of a sharp reversal if volatility increases. And so they're always on our radar screen, but this is a potential turning point that's very interesting. The other key winners in there, you see a bunch of oil and energy and oil exploration. The U.S. commodity index, reinforcing that global commodity. And even the utilities AlphaDex, FXU at the bottom, had a really excellent return. So this may be a short-term boost as people are rotating money perhaps to the defensive sectors. All right, next up is the market health check. These are daily charts. So the vertical blue lines are 10, 20, 30, 40, 50, and 60 in the thick lines of look-back periods. The horizontal red lines are price levels that used to be resistance are now support. If the market collapses here, those red lines become price targets on the way down. The purple lines on the way up are price targets of that were once support and are now resistance, and that becomes the price ladder on the top. You can see the 10-period RAF regression channel in blue. The 10-period is sloping downward, and its channel is defined by the width of the river itself. Interesting. And price is right at the middle of that RAF regression channel and on the Bollinger Band mean, so it's smack dab in the middle of fair value. No directional tendency in either direction. The 30-period channel lagged by a day is in the black. That's also got a negative slope, which is generally a sign of some weakness. I want you to notice in the three declining highs inside the dragon. So we have one 60 days ago, and then 30 days ago, and then about 5 days ago. So that's a series of lower highs and at least stable or lower lows on the downside. So this is a market that, if it fails here, would not surprise anybody. And then you can see the red shaded area is the 200-day moving average. And if that breaks, then it's the possibility of a bearish move to the downside has opened up. That would trigger sharp volatility spikes as people hedge their long side positions. And so that places this market in a very vulnerable state. We're about 7% off the swing high of 60 days ago. And so that 10% sell-off from the swing high is right at the 200-day moving average. And so this declining triangle, these lowering highs, is pointing towards a significant intermediate term decision point coming up, price testing the 200. If it holds from here, then the upside gets back all the way up to 285 at the previous swing high. And then a collapse below the 200-day moving average would really open the door for another 5 to 10% immediate sell-off. Now looking lower at the MACD histogram, that's the 10, 30 with a 5-period smooth. You notice the signal line is now below zero. That has a negative predictor. That's a negative bias. It has just crossed over its signal line and pointing downward. So that means it's just at the beginning of weakness. And so we could easily see that 5% sell-off from here without any surprising interest there. So not surprising at all. Next up, we're looking at the ETF2 regional report, the top 10 indexes of the world market model. 3 of the 10 are on buy signals, 7 are on cash. That puts the model's theoretical allocation strategy at 30% invested, 70% in cash. That reflects the general broad weakness in the market to minimize exposure, to raise cash to exploit sharp moves, but also to protect against downside volatility. And that has gotten weaker in the past week. Last week we were 40.60, now that model's 30.70. So the market is still bullish normal, but just barely. The S&P 500 with a strength score of 39 is still better than EFA, which is in the red and weak at 23. So the U.S. is still better than the globals. And then inside the U.S., the order of merit is technology at 61, also the strongest sector in the world right now among the big indexes, followed by mid caps, small caps, and then finally the U.S. S&P. And so that leads me back to the technology leadership sector here. So if the market's up and technology's better, that's the way to go. That reinforces strength, and that's the way we should play it. Inside the sector spiders, real weakness in the red there with energy, financials, and healthcare. What I like about energy is that it's been really horrible and got to a 19 on strength, but had a pretty good week last week, and so that could be like a weekly hook from the bottom of its channel. So we'll be framing that as a swing trade. Next up, the world market model, starting with the U.S. on the inside. Only technology in the Qs is in the green. The blended large caps, mid caps, and small caps are slightly below average. The value plays are slightly above average. Europe is a mixed bag again between strength and horrible weakness in Austria, excuse me. In Asia, Japan below average, Asia less, Japan above average, and then a mixed bag among the countries in Asia. So again, this is a market that is sorting itself out in the midst of weakness. It's being differentiated at the sector level, but those are very vulnerable to sharp changes with this much uncertainty in the market. You combine some political and economic concerns and the weakness of the past 60 to 90 days. This is a market that is very fragile. And so shorter terms and volatility-based trading is indicated. Next up are the ETF top 30 as measured by the ETF2 database. So I like green on strength and white on consistency. So the relative strength currently is in the strength column. Consistency is the 10-week moving average. So what I like to see is the Spiders S&P Retail XRT in the third position. That's white on the consistency, meaning it's been above average for the last 10 weeks, but now it's green on this week, which means it has moved into exceptional leadership. So this could be emerging exceptional strength. Those that are green and green have been above average for a lot longer, and so sector Spider of S&P Retail could be earlier in its parabolic move towards the top. So that makes it an interesting play, as does EWU with the UK. Blended commodities, DBC, and the Qs themselves are both that green and white. So those are exploitable moves. Reinforcing success would be the reason to get into those. Conversely, emerging markets EEM is green on consistency but white on strength. That means it's been exceptional over 10 weeks, but now just above average on one over the last week. That's a sign of a weakening bull, and so we would want to be capturing profits in that if we see the opportunity, and maybe even getting short if the market is weak. ETF liquidity, these are based on the average daily dollar volume of the last 30 days. These are the 30 most liquid ETFs. And then under the ATR percentage, you will see those that are shaded in green are also exceptionally volatile. So that makes them excellent intraday trading candidates because they have both high volatility and high liquidity. So the Qs, the VIX, XLK technology, oil and gas, semiconductors, Brazil, and biotech are all inside that category. Those that are in the red for ATR percentage have a lot of liquidity, but maybe lack the intraday volatility to make them good day trading candidates. Okay, next up is the daily report for Monday based on Friday's closing. All right, next section is the daily report for Monday based on Friday's closing. So this is a summary of those daily indicators. The only thing we need to look at there are the channeling and overreaction systems for the Big 10 ETFs, no signals there. 10-day max pains. 3M is of a lot of interest there. That's the number one max pain in the Dow. That was the one that was down 9% and is just horribly oversold. And so that deserves our attention. Caterpillar, IBM, GS, and Procter & Gamble. So IBM is interesting to me there because technology has been strong, but IBM is suffering. That anomaly between the company and the sector makes it interesting. So we'll look to frame that one. The 10-day min pain are the symbols that are the least distance from their 10-day high. So they have sold off the least. So Verizon, Home Depot. So Home Depot is interesting because that was a % winner on a previous report. So the Home Depot. And then Chevron is of interest because of strength in energy. We're going to see Verizon in a little bit is also in a super pinch. So that makes it terrific. Next up is the Dow Tactical Summary. So on the left-hand side, you see all the warning lights for the various mechanical systems. There's a half a dozen dojis were formed. There's a channeling and overreaction on Caterpillar, a 5-day down on 3M. Beauty. I guess we're just going to look at 3M, which is also a max pain, and it's the number one max pain range compression, and has an 8.7 to 1 reward to risk ratio. So maybe we'll just look at that one. It has an RSI2 value of 0, meaning it's had a 2-day washout, which makes it a high probability for a gap down and reverse, thanks to Larry Connors and the great Mark McDowell. IBM is also 8.7 to 1 and ended up in a doji on Friday. And that was down over 7% over the last 10 days in the red, you notice. And it was it's number 2 on the max pain range compression, so that's of interest. Now, Merck is interesting for the fact that it has no negatives or anything. It was a doji. It's 3 to 1 on the auto framer. It's been performing just fine in the middle of the pack quietly, so that's of interest to us. The percent winners from Friday, the 1-day percentage winners, were Microsoft, Nike, Verizon, and Chevron. So Verizon is interesting because it's going to be a super pinch, Chevron because it's energy, and if we saw a 1-day continuation of momentum, those ones would be on the short list to reward. So if the market was good and those were better and took up Friday's high, that's a very low-risk trade in Verizon and Chevron to get well started. ExxonMobil, on the other hand, was down almost 4% and was a 551W. So that's when you look at strength in the energy sector, but it had a horrible 1-day. That makes it interesting, and so we will take a look at that as a trade frame. In the ETF 30, a handful of dojis. There's a channeling and overreaction in both XME, metals and mining, and then the industrials XLI. So that puts a real interest on Caterpillar, Alcoa, as well as the XL series, based on the weakness in those regions. Real estate and utilities were both percent winners, IYR and XLU. So those alternative asset classes, if you will, had good 1-day performances. And so if the market were weak and those continued to be strong, that could be a sign of sector cycling and money moving out of equities into those defensive plays. So it wouldn't be surprising to see them do well if the market were weak. So that'll be on our list. I also like the price action in Mexico. It's the number 1 on max pain range compression, 5.4 to 1 reward to risk. But it had a great day on Friday that they were willing to carry overnight. And it's a 551W swing trade pattern. And it's a frog champion, so it's both a good swing trade as well as an intraday trending symbol. So as always, that'll be on our short list. All right, next up is the daily pinch and stretch report. So the first column, the most positive Z-score stretch. In green are the ones that have more than one standard deviation stretch above their Bollinger Band mean. So General Electric is almost 2 sigma above its own 30-period moving average. And so these are candidates for either continuation patterns to the upside or reversion to the mean. You can see the size of the move that gets you back to the mean. So it's a little over 5% for General Electric just to get back to the mean. So that's the reversion to the mean trade. The most negative Z stretches, this is the same thing but on the downside. So 3M is almost 10% below its 30-period moving average. And that's over 3 sigma of stretch. So that is a system shock it has experienced. So one of two things. It's either proper and there's more pain, so you want to pile on weakness by getting short if it continues to fail, or it's an overreaction and then there will be a dead cat bounce as it runs back towards the mean. Now there's a 10% R capture on that kind of move. So that makes 3M interesting. And then Apple is also interesting at 1.7 sigma below its Bollinger Band mean. And who has to own Apple? Everybody in the world at some point. So is that an opportunity to buy Apple on sale? Some people will think so, and there'll be buying pressure. And that may lead to a tradable moment back to the mean. Or if Apple were to fail and continue the weakness from Friday, then this is a potential downside move that's signaled by the fact that it's already an extreme condition, and so on. The next two columns are examining the width of the river, looking at the 30-day standard deviation. And so those that are in green in the third column, these are ones that have had an exceptionally directional 30 days worth of movement that has caused the river to get extremely wide. So 3M is also 2.65 standard deviations of width, meaning it's extremely wide at this point. You combine that with the 9% below its 30-day moving average, and so you have it's at the bottom of an extremely wide river, so it's ripe for more failure or a nice reversion to the main trade, and so on. In the most compressed pinch box, those 5 symbols in the red are ones that have had exceptionally sideways and low volatile moves for the last 30 days and are now prepared for a Z3 pinch pattern. Now, 4 of those, gold, Brazil, Latin America, and Disney, also have their 4 regression lines tightly compressed, and so they're postured for a super pinch, which is our nirvana for starting points for long, extended trending moves away from this consensus of fair value. It'll start with the traders and the RL10s departing the river, and then if momentum follows suit, this will become a compounded directional move, which sets up all our hybrid frogs, owls, and collapsing dragon trades. So those 4 symbols are certainly on our short list. Brazil especially interesting because it's also a frog champion, both a great swing trade and an intraday trading vehicle. So lots to work with there. Next on the auto framer. In the top stack, you see all of the symbols that test out better than 2 to 1 on a mechanical trade frame using the 10-day high as the profit target and yesterday's range risk as the initial risk. And so this gives you execution risk back to the 10. So 3M, again, not surprising, almost 9 to 1. And these all test out well simply on the basis of trade location, and you can see under the framing data all of the mechanical price levels to construct those trade frames. Finally, the regression line fractal framework. Excuse me. There it is. So in the top shelf, in the green, for each of those populations of symbols, these are the symbols that are the most number of ATRs below their 270 period regression line, the long-term fair value. So Procter & Gamble is almost 10 ATR below its RL270. So that's a potential deep value play. 3M is 9.5. Walmart is 8 ATRs below its fair value. Who's got to own Walmart? Everybody, if you're a money manager. So McDonald's and Apple. So the green, the top shelf, these represent potential buying value on sale opportunities if we engineer the trade frame that way. In the bottom shelf in the red, these are the ones that are the most numbers of ATRs beyond their RL270 long-term fair value. So General Electric is 5 ATRs above its fair value. Now remember, GE has been crushed in price over the last year, and so the RL270 reflects that. And now the recent gains in General Electric, that may actually be the sign of a significant reversal. A bottom may have been put in, and so this is the spring for General Electric, and so on through the rest of the RLFF. Finally, the daily squeezes. These are the symbols that have large daily ranges, but which closed with a tightly compressed range on Friday. And so if we were to use a mechanical frame and simply get an average range move from there, you would see the reward to risk ratio expressed. So Monsanto, MON, well, diamonds and the spiders, oh my. So those are at 3-1. What that tells you is that the range compression on Friday for the market was so small that a mechanical trade frame can lead to a very interesting one-day pop and a directional move that may attract momentum. And so this is a day on Monday that you want to get the market right. When the market is postured for a potential snap directional move, and that's going to trigger everything else that's correlated to it. And so Monday is going to be a very interesting day. That's a day that you must get the market and the volatility right. The least surprising play would be a sharp volatility move with an adverse move in the indexes to go down and test the 200-day moving averages, which are about 2% away, and then finding support and then a sharp recovery. That would be the least surprising play in this market that is very fragile. So let the traders beware. This is a time this week ahead to be excellent at your short-term trading, to be mindful of your overnight risk posture, which should already be lower than normal because of the weakness in the market, and then to sharpen your knives and be ready to trade. That's everything I wanted to cover this weekend. Here at the workshop, we're going to be working trade frames for many of these symbols and working through them tonight and tomorrow and posting the results in the chat room for those of you who are members. You have a chance to see us at work there. So this is Ken Long of Tortoise Capital. Keep your risk measured and your powder dry.